I want to start off by introducing some of the team here at RVW. Stefan, if you'll say hello. Heads up, Stefan, Lauren, my father, Selwyn, Marianne and Kelly were up front. Donovan's running around. I think that's who's here. And I just want to tell you how grateful we all are to our clients who really make showing up and going to work every day amazing. We love working with you, planning for you and your family and your kids to really create peace of mind and security for you. And that's really a great honor. We take it quite seriously, and every one of us is passionate about what we do and who we serve. So thank you. Before I introduce Kristina, I wanted to just tell you a little bit about where we are right now. Especially on a day like today. Hopefully you haven't looked at your phone yet. And just want to go over a few key economic statistics for you to give you a little bit of, go back one, hold still for a sec. To give you a little bit of insight as to where we see things based on current economic data. And when you're building portfolios, you really need to guide your ship by the stars and not the prevailing winds. There will be wins, there will be bumps, but the data as we see things continues to be very strong. So where we stand now, 51 of the S&P companies that have released their earnings reports this quarter have exceeded their benchmarks. That's 84% have exceeded their benchmarks, or the consumer sentiment, or the analyst sentiment. It's a fantastic result. And that's largely because the forward-looking earnings is about 5.85%. We actually have a slide on that. So 5.85% is the forward-looking earnings of the S&P 500. So the portfolio, if you just bought the S&P 500, is delivering 6% growth. That's hugely comforting to us when we go out and buy publicly traded securities. Looking back at where we've come over the last 10 years, we lost 9 million jobs in the Great Recession. And since then, we've added 20 million jobs. So the statistics on a macro level and where we stand now are good. And then this last slide that I'll actually ask you to put up, Simon, that's the forward earnings yield, 5.85%, that statistic, and one more. Keep going. Here. This is sort of one of these foundational slides that we must look at regularly. It's a bit like Solomon carrying his Bible on his arm wherever he went. This is the slide we all carry with us wherever we go. Within the way to read this slide is the red dot is the lowest value that the S&P 500 drops to within a given year. And the bar is the growth, or in some cases the loss, but the full year results of the S&P 500. So if you look how low those red dots can get relative to where the year ends, it's remarkable. A drop of 13.8% within a given year is normal. That's 98.6 under your on a thermometer reading under your tongue. Normal. If the S&P 500 drops 13.8% within a given year, that is absolutely normal. And that has historically ended with an average of growth of 8.8%. But the things that will affect this ride are short-term noise, short-term movements, geopolitical issues, and that's really why I wanted to introduce Kristina Hooper, who's here to talk about trade wars and how that's going to create noise and news for the short term, but we don't see this as affecting the long-term outlook. And with that, I want to introduce Kristina. So thank you very much, Kristina.
Thank you. Good morning. It is absolutely a pleasure to be here with you. I'm really excited to take you through this deck and to talk about the economy, markets. This is a small group, and so feel free, and I actually think this will be most valuable for everyone, feel free to interrupt as I go through this presentation. Ask questions, challenge me if you don't agree with something I'm talking about, because I think it'll be a much better and more engaged event for all of us if that occurs. So let me start by saying that, yes, we are in good shape. The economy is going strong in the US, and globally it's doing quite well. I may seem a little gloomy because I focus on risks, But when you have a long-term time horizon, please know that so many of those risks evaporate. But it helps explain why we're experiencing volatility right now. And again, volatility isn't bad. It often creates opportunity. So I just wanted to give that caveat before I go through this. And unfortunately, this doesn't seem to be scrolling. Maybe that... If it is a PDF, that might be a problem in terms of... But, okay, I don't need this.
You can always do like a next slide.
Yes, I'm happy to do a next slide if you just want to hit next. All right, fantastic. So actually, I won't spend time on the economic and market overview. I'm just going to get right to the first theme of disruption, if you don't mind scrolling us through to disruption. Because I think this helps understand how we are where we are. And again, disruption isn't a bad thing, but it does create volatility. And so again, you can see asset class returns are quite good. And if you just keep scrolling to that next section, which is, keep going, it will take us to disruption. Okay, great. And if you go to that first slide, please. Great. So to understand where we are today is to understand our response to the global financial crisis. That might have seemed like a long time ago, but in fact, it was just 10 years ago. And I can still remember the kinds of panic that rippled through the system when Lehman Brothers failed, and you may remember the same. Our response to the crisis was unusual in that in the US and other developed economies, the response was largely a monetary policy response as opposed to a fiscal stimulus response. The only thing the US did, you may recall, was about a pretty small shovel-ready projects outlay in 2009, but really the key response was monetary policy, and it wasn't just taking rates down. In fact, rates went down from, at the start of 2007, above 5%. Oh, thank you. The Fed funds rate was above 5%, and it went down to that 0 to quarter percentage point band in the course of about 15 or 16 months. And of course, we weren't alone. Other countries, other developed countries did the same. But that's not all. As a sign of, I think, desperation in the global financial crisis, we went into our experimental monetary policy toolbox and pulled out a crazy little thing called QE. Now, for those of you who really focused on this, you would remember that this was never really used before, that the Bank of Japan was the first to use it about 5 or so years before, didn't really do much with it, and was largely viewed as a failure. It actually was just an esoteric academic idea back in the 1960s, proposed by the thesis advisor to Janet Yellen, coincidentally. But using a central bank's balance sheet to manipulate rates on the long end was just an experiment. And not only did we go into it whole hog, the Fed took its balance sheet from $800 billion to $4.6 trillion during the course of just a few years. We also saw other central banks do the same. The Bank of Japan actually extended its balance sheet. That's the one on the left. It went from 14.4% of GDP to 88.3% of GDP. So actually, we didn't really do that much with QE relative to some other economies. The European Central Bank also drove up its balance sheet quite significantly. Now, I'm spending time on this because, again, this was such an unusual response to the crisis. It wasn't government spending to stimulate growth. It was just taking rates down, essentially, on the short end and the long end. Now, the problem with just taking rates down in a crisis is that you can bring a horse to water, but you can't make it drink. And so we lowered rates, but we couldn't force banks to lend, and we couldn't force households or companies to borrow. And so the major impact occurred to assets and asset prices in particular. And so if you were to look at this through the lens of history, you'd see that we used monetary policy, and monetary policy proved to be a blunt instrument, not a surgical tool. It didn't really help our economy recover right away. In fact, it just impacted asset prices. And I can't seem to get this to work again. But if you don't mind scrolling through to the next one, what you'll see is that the response to the crisis, what we saw as the effective monetary policy, ran counter to the behavioral response to the crisis, because naturally people got scared, especially those that didn't have good advisors or had no advisors at all. They got out of stocks at absolutely the wrong time, so they locked in losses and stocks rose. Home ownership fell. Some of it was involuntary. We all saw a lot of foreclosures occur around the country. Home prices ultimately rose as part of the recovery, but it took time. Allocations to cash rose. When people got scared and got out of stocks, they went into cash just as rates were falling. So they were being punished for being savers. In fact, does anyone want to take a guess at, well, let me give you first this statistic. Back in 2005, if you put money in a savings account and you said, you know what, I just want to get $100,000 a year from my savings account, it would have taken you $4.9 million in a deposit to just get $100,000 a year. But that was before all this experimental monetary policy from the Fed. Anyone want to take a guess in 2012 how much money you would have had to put into a savings account to get $100,000 in cash?
15 million.
Close to 60 million. 60 million. And so what that tells you is that financial repression occurred. So we punished those who were risk averse and we rewarded risk takers. And all that really did was all the lucky people who had good advisors who stayed in stocks experienced a nice run up. Others didn't. And so essentially wealth inequality grew. And there's a lot of academic work on income inequality, but I would argue the much bigger issue is wealth inequality. And what we see historically is that typically when you get a lot of wealth inequality, that's when you get a rejection of the status quo, interestingly. But also you are sitting on a lot of monetary policy that's very experimental at this point that you have to get rid of. Do you mind scrolling through the next one? And so here we are, and really we've been here for a few years now, where we are seeing disruption all around us, right? We've got the potential for monetary policy disruption because we're unwinding an experiment, and that's an experiment in and of itself. Also, the initial monetary policy response altered markets. It tamped down volatility dramatically and brought up correlations. In addition, you've got a changing world order, right? A lot of countries have experienced a rejection of the status quo. And so many institutions are changing. They're shifting global alliances. It is a very unusual time in terms of disruption. And then finally add to that, and this really has nothing to do with the crisis, but we're also in a fourth industrial revolution. What does that mean? Technology is changing industries, and many industries. Now, there's a lot of good that comes from that. Productivity improves. We save money, typically, as technology improves and innovation occurs. But it doesn't come without its prices. That's why we had, of course, Luddites in the 19th century fighting farm machinery from being brought in. There's a fear of job loss. And in fact, technological innovation typically does create structural unemployment. So right now, because the economy is booming, we have a shortage of truck drivers in the US and to a certain extent Canada. And in fact, you may have read articles about truck drivers getting paid about $100,000 a year. You don't need to have a commercial license, we'll train you. And so it is a great time to be a truck driver. The problem is driverless cars are coming. In fact, Ford just announced the other day that it'll have driverless cars on the road in 2021. I'm not sure they'll come that quickly, but I do know that certainly some Teslas already have driverless car features that I've seen and experienced. I think that driverless trucks will be here in probably the next 5 to 7 years. And so what does that mean when, if you look at the statistics, about a little over 3%, close to 4% of jobs in the United States are involving driving. So truck drivers, cabbies, Uber drivers, all those folks, they may in fact ultimately lose their jobs. Now, what you hear from tech CEOs is that for every one job lost, 3 jobs are created. The problem is that very often the job created does not have or does not need that same skill set that that the lost job has. So for example, when you usually lose a job to technological innovation, the new jobs created are in things like coding. So your average truck driver may not qualify to become a coder. And so structural unemployment becomes an issue. It also creates what we call economic insecurity because people worry about their jobs. And again, that's why we saw Luddites fight farm equipment. Now, ultimately, over time, everything works itself out. We've gone through other industrial revolutionary periods. And what usually happens is over time, new jobs are created, but there always is that gap period where you see structural unemployment go up. And that's why we're actually hearing tech CEOs starting to talk about ideas like basic income. But I would just suggest, again, this creates an environment where there's more volatility. If you want to advance to the next slide, please. And so let me just dive down into monetary policy for a second. What we see is that in the US right now, the Fed is tightening in two ways. It's doing the normal tightening by raising the Fed funds rate, but then it's also doing this crazy thing called balance sheet normalization. And that, of course, is unwinding QE, that crazy experiment that we went through. Now, usually central bankers are not good at walking and chewing gum at the same time. It's hard to do two things at once, and the Fed is pulling two levers at once. So we just need to recognize that that could create more volatility, and I think that's why we've seen the stock market really go through a lot of gyrations in the last few weeks, including, of course, today. Much of that was triggered by the 10-year yield going up, because every time yields go up, there tends to be a re-rating of stocks. So this is not a bad thing, though. Actually, this is, I would say, as monetary policy normalizes, capital markets normalize. And so what we're just seeing is actually a return to normal. It's just been so long since we've seen higher volatility that it seems abnormal, but it's actually more normal. But we just should expect that this is likely to continue, especially as other central banks normalize. And again, volatility creates opportunities. It's often creates not only buying opportunities, but the potential for emergence of very interesting leaders in different areas. Because keep in mind that when rates are low, many, many companies can do well. But in fact, raising rates almost forces the best companies. It's something of Darwinism to occur. And again, so you have a separation of the wheat from the chaff. If you could turn to the next slide, please. Now, we also, of course, have that changing world order. Now, so much of this really has nothing to do with stocks, even though you could see an impact in the shorter term. In fact, Benjamin Graham is famous for saying, the old investor Benjamin Graham, has historically been well known for saying stocks in the short term are a voting machine, but in the long term, they're a weighing machine. And so, yes, we could see some geopolitical turmoil impact the stock market today. That's that voting machine. But in the longer term, and that's why he's famous for saying this, it is all about a weighing machine where fundamentals matter. And so while we can worry about a lot that's going on geopolitically, really the only things we should be caring about are the ones that impact the bottom line. And so trade could be problematic in the shorter term because we are seeing disruption to a system that really hasn't seen much change in decades, really since the World Trade Organization was formed in 1995. So we have to expect that that is going to be a source of disruption, and I think we've already started to see that. Next slide, please. And so you can see, if I had updated this slide, unfortunately, I haven't had a chance to update this slide, but if we were to update this slide as of yesterday or even today, what you'd see is another big spike in volatility. And that's the kind of volatility we haven't seen in a while. And again, I would argue this is a return to a more normal environment. So you may walk out of this room and be worried because you see the Dow is down 500 points or whatever. Just know that this is part and parcel of a normalization of capital markets. If we could turn on to the, and if you could just advance that slide once more to the next. So keep going, one more. Great, divergence. So let me just stop here at the end of disruption to see if anyone has any questions.
Yeah, you didn't say anything about Brexit.
I haven't, yeah, okay. So Brexit is something that's not going to impact us in the US, but you're absolutely right. Brexit is an issue for not even so much Europe, but the UK. And where I see it creating a central problem is because it creates economic policy uncertainty. There's no playbook for Brexit, but I would tell you that I think the UK has written the playbook on how not to do it. This is a process where you invoke Article 50 and you know that the clock starts running. And you've got essentially exactly 2 years to get everything done. And that includes all member countries in the EU ratifying whatever the agreement is. And so instead of doing a lot of negotiations before invoking Article 50, Theresa May hits the Article 50 button and then starts negotiations. And what we know about our European brethren is they don't often work as quickly, or as there's a lot of breaks in between meetings. And so they have gotten no progress. She also has no real mandate from within the UK. There's so much splintering going on, and it's absolutely so difficult to keep track of exactly what the issues are, because it almost seems as though the Tories, her own party, really have continued to pick fights with her over the silliest things. Now, I heard from someone, I met with someone who had been part of her government, who said this was actually all part of her, this was part of her plan, was that if she invoked Article 50 because she knew she wasn't going to get a consensus and let the clock run, that ultimately the UK would have to come together, her cabinet would have to come together and agree to something because time was running out. And so that's how she would force the issue and get consensus. Well, now, of course, it looks almost a certainty that there's a no-deal Brexit. I mean, I would be very surprised if we didn't have that. And so all I can think of is all these companies in the UK that have absolutely no idea what's going to happen come March 29th. And as we talk to them, what we hear is it's very difficult to have even contingency plans because they don't exactly know what will be happening. That even trying to keep a transition period where the status quo remains is a huge problem for and is objectionable to so many Tories. So what you see is companies moving out some employees. I mean, the reality is companies want to be headquartered in London. They'd rather be there than Frankfurt. So they don't want to move out, but they're being forced to, or at least moving as much of their operations as they can. So it is a big issue, and it's certainly, I think, a great illustration of economic policy uncertainty and how that can really, and we've seen this historically, it's a real problem in terms of preventing capital investment and, of course, slowing down hiring. We're hearing that in the US vis-a-vis trade. You'll see in the Federal Reserve Beige Book, companies will be saying, business contexts in different regions will say, we just don't have a lot of visibility on trade policy, and so we're already starting to curtail capital investment plans, which unfortunately runs counter to one of the incentives in the tax reform package. But the UK is a cautionary tale. Yep?
You mentioned that we're looking at deglobalization.
Yes.
Other than a backlash against immigration, where else is it deglobalization? Aren't jobs going to the cheapest countries?
Well, what we're seeing right now is the starts of a disruption of the global supply chain because of the trade situation. And so that's really, it's not so much about immigration, it's really about trade and tariffs. And so, for example, the sell-off that we experienced about a week and a half ago, that was triggered, at least in part, by an earnings call from Fastenal, which is an industrial company, but one of the first to report, something of a canary in the coal mine that said, you know what, that first round of tariffs against China didn't impact us. The second list of tariffs didn't impact us. The third list is actually impacting our North American global supply chain. And so what happens is you start having inefficiencies because we've always operated on this principle of comparative advantage. We've worked towards trying to lower tariffs and make trade freer. And so this is creating a situation where some companies are changing, especially with the US MCA agreement. We're going to see some disruption of the global supply chain because of requirements on where items can be produced and where assembly can occur and the minimum wage for assembly in certain places. So it's essentially limiting free trade. So my focus is on trade and how that's sort sort of creating a deglobalization. Sorry for that long-winded answer. Any other questions? All right, on to divergence. Well, 2017 was an environment where we had something of a synchronized global growth environment. But 2018 has changed that, and I'm just going to show you a few slides that show that. And again, I think this is part and parcel of what we're starting to see with deglobalization. What you'll see is that, yes, growth is strong for countries like China, countries like India, although one forecast is from April, one forecast is from July. So you can see some fortunes seem to be improving, some seem to be deteriorating a little bit, but it's certainly a world in which we're seeing growth. But when I say it's not synchronized, we're certainly seeing fortunes change, especially for emerging markets, which are being impacted by the Fed tightening. And if you could just turn to the next slide. And let me dive down into regions. So if we were to look at Europe, for example, what you will see is a lot of differences between countries within the European Union. And so Germany's doing, and this actually is a measure of youth unemployment. So I try to look at obscure statistics that give me a real sense of what's going on in a country. And for me, youth unemployment is very helpful because it speaks to the future as well, because if young people aren't acquiring skills today and aren't getting job experience under the belt, it's going to be much more difficult to employ them in the future. Whereas a middle-aged person who loses their job, it's much easier for them to find work, apples to apples. So youth unemployment rate, as you can see, is horrific, above 30% for Italy, Spain, and Greece. And when anyone asks me why Italy would want to leave the European Union, as it has suggested with its new coalition government, I point to information like this, which shows you that they're not really benefiting as much from being in the European Union as, say, Germany, which has low unemployment and is really benefiting from a low euro, which enables it to export a lot of nice Audis and BMWs and Mercedes. So this is not even synchronized within region. Even this is a monetary union, growth is not at all synchronized. In fact, Italy is just getting back to where it was before the global financial crisis in terms of GDP. If that gives you a sense of how much further back it is, similar to Spain and Greece. Now, they are benefiting from being in the European Union because very few people would be buying their debt if it weren't for the ECB buying debt, and certainly preventing systemic risks from occurring. But it is a situation where we're likely to hear and see more about Italy wanting to get out of the European Union. They submitted a budget that essentially is thumbing its nose at the European Union because it violates the fiscal discipline covenants that the EU has imposed on them. I want to turn to the next slide. Japan is in a very interesting position and is unlike any other economy in that its unemployment rate, as you can see, has gone down dramatically. This is an economy to start with had an enviable unemployment rate, and that's come down quite dramatically. It's below 2.75% now. But inflation has never really picked up. You know, that whole theory that as long as you continue to lose work, continue to not be able to source workers, you're going to have to pay more for them and inflation will go up. That's never happened in Japan. So the Bank of Japan has the luxury of not having to raise rates because it has very low inflation, even though unemployment is extremely low. And that's a good thing because it has so much debt. It's about 240% gross debt to GDP in terms of government debt that it would be very difficult to service that debt if it raised rates very much at all. Now, if we turn to the next slide, emerging markets, and I apologize for this slide. I'm actually going to revise this slide in the next version of the chart because it's all over the place. But this gives you a sense of sort of the changing fortunes in different emerging markets economies. Brazil and Russia really have very anemic growth. And that's forecast out through 2019 as being relatively anemic. But look at India and look at China in terms of growth. So it's very hard to paint emerging markets with the same brush. And in fact, if we were to actually look at the kind of debt different emerging markets countries have, it is just a situation where there are some winners and some losers. And we're going to see more and more of that revealed as rates go up. rates have this funny way of going up and revealing who's swimming without their swimsuit on, just like when the tide goes out. It's another quote. I think this is from Warren Buffett, though. I'll give him attribution for it. But it's not a bad thing. It'll separate the wheat from the chaff, but we have to recognize that it's not synchronized in emerging markets. Some countries, especially emerging Asia, have had a lot of discipline that they learned really through going through the crisis 20 years ago. And they implemented enough reforms that they're in a much better place today than, say, Latin American emerging markets countries. And again, this is a generalization. Some actually are in good shape. Some aren't, like Argentina. If you want to flip to the next slide. Now, the risks to economic growth from protectionism. I get that question a lot because I think we just have never seen a trade war, right? The last major trade war was in the late 20s, 30s with the Smoot-Hawley tariffs triggering a lot of countries implementing tariffs. So by the end of the decade, there were 20,000 tariffs on different items levied by different countries. So we've really never lived through that. We don't know what that means for growth. But what I can tell you is that I think it's going to be more impactful today if we get to that point than it was back then, just because back then, international trade as a percentage of GDP was a lot lower. Even back in the 60s, international trade as a percentage of GDP was just in the low 20s. Today, it's almost 60% of GDP. And so the good news is, I think the tariff situation could be resolved relatively quickly. But we just have to expect that until that happens, we're likely to feel pressure created by trade. And if you can just slide to this, flip to the next slide. So I get questions a lot on the yield curve and if it inverts, what happens. I would just say that a yield curve inversion does not create a recession. It does certainly have some predictive powers. But right now what we've seen is actually the yield curve ease up a little bit, the spread widen a little bit. Even if it were to invert, it takes a long time for a recession to occur. So I think a recession is far off at this point. And again, it's part of what you do. And if you were to pull out of stocks just because you're worried about a recession, you would miss out on a lot of upside. So this is about weathering storms, but also informing about concerns that investors may have or may hear going forward. So if you want to turn to the next slide. Valuations have certainly risen, and as you can see, the dark blue line is valuations, essentially the S&P 500 price index, and the lower line is earnings. I like to think of it as sentiment and reality. We certainly have earnings keeping up with stock prices, but there's some level of vulnerability there that just suggests to me being diversified, having some exposure outside the US, and of course, focusing on valuation as a factor makes a lot of sense in this environment. If you want to keep going. And of course, valuations differ a lot by region. Some would argue you get what you pay for, but there are opportunities everywhere, and there are low valuations everywhere. All right, I'm going to keep moving on to, if you could take me, yes, to demographics and debt. Now, this is sort of the longer term thing to be thinking about. This is not something that I think is going to impact markets anytime soon, but we just need to be aware of it. And if you turn to the next slide, you'll see that there tends to be a correlation between population growth and government debt. That developed countries with low population growth, so look at that far left column, Japan, Greece, they have actually negative population growth. Luckily, the US is in a pretty good position relative to other countries. The idea is that as demographics change, we tend to have higher debt levels. And in fact, there are many developed countries that have high government debt. Now, the good news is government debt usually is cheaper to service for developed countries than private debt, than corporate debt, but it's just something that we need to be aware of that often makes it difficult over the longer term to make decisions on spending. There's nothing we can do. There's just a lot of entitlement programs, but it's changed a lot, even from the 1980s. And some of it has to do with just an aging population and what happens with Social Security, especially if you're not investing it in a diversified portfolio. I mean, the irony is that Social Security is the biggest pension fund that we know of in the United States, that we have in the United States, and yet it's invested essentially in cash and cash equivalents, as opposed to stocks and those that would match the needs of Social Security. So that's going to be pressure going forward, but longer-term pressure. If you turn to the next slide, you'll see that right now we're at about $15 trillion in debt. That's expected to get to about $27 trillion in a decade. Our servicing costs are expected to go up too, right? Because the Fed is raising rates. I don't think it's going to raise rates very much, but that'll take us to 3.4%. So we'll likely have a debate in the future about what to do. Hopefully we'll come up with what I think are easier solutions, like investing Social Security in equities. If you keep going, just more on debt. And my takeaway from this is that the Fed and other central banks can't raise rates that much because of this. That they're cognizant, even though we won't see it in any FOMC minutes, they can't take rates back to where they were before the crisis in 2007. We won't see the Fed funds rate get back above 5% anytime soon. It would just make it so hard to service debt, and I think that's true for other economies as well. So that just means that we're going to have to be more focused on income and capital appreciation, and it makes it more important to have a financial advisor, because this is not going to be easy. We can't just stick it in a bank and get a CD yielding 7%. Who knew that we'd look back on the early 80s as such a great period in terms of being able to get great yield? Anyway, if you want to turn that slide. And so we're going to have to source income from a lot of different places. And one of those, of course, is dividend-paying stocks. And the good news is dividend-paying stocks typically offer lower volatility anyway. I want to just advance to the next slide. And of course, we also have to encourage people to save. There are a lot of pockets of America. Oh, please, go ahead.
You kind of in passing mentioned a moment ago about investing investing Social Security. Mm-hmm. And I'm just, I've heard it for years, and I'm just not sure I understand. If the U.S. and the Social Security system were to be investing in the stock market, wouldn't that create a tremendous imbalance in supply and demand of funds? And what would that do to the markets in general with all that money now being invested in that manner?
Well, actually, and I should give the caveat that I don't know I'm not aware of any studies that have been done on it. I don't know if it's been taken that seriously. But I would actually expect that to create something of a balance, because there's an assumption that as baby boomers age, they're going to move out of equities. So actually that could be a strong creation of a move in. Now, of course, this would have to be some kind of a diversified portfolio that would also have exposure to fixed income. So it actually might not be that problematic for markets. It might actually provide something of a balance that's needed as demographics alter investor preferences. I'm just telling you that this is a situation where we're likely to start hearing more and more going forward about the difficulties of achieving everything the United States wants to do. If you go back to the early 1980s, 33% of the federal budget went to entitlement programs. Now we have about 68% of the federal budget going to entitlement programs, and that's projected to increase. So something's got to give, and
There's a lot of reasons for that.
Exactly, something's got to give, and so that's what the government is here to explore. But I would just say that hopefully there will be some ideas that don't, for example, restrict spending so much that it creates a very significant recession. It's a delicate balancing act. But I just look at, for example, government pension programs, outside of Social Security. It's done with investing. Think about, for example, my mom's a teacher's retirement program, they're invested in equities. So it would make sense that you would do that with Social Security as well. Just an uninformed non-government bureaucrat suggesting that. The need for retirement savings continues. We have to encourage people to save, because that's going to create a problem. Everyone is relying on Social Security, and so if the government chooses to cut it, that's going to be very problematic when the average account balance is only $111,000, and that's people who are nearing retirement. If you want to take the slide to the next one. Similarly, we're not seeing people saving for education. Only 29% of families utilize 529 plans. The average balance is $5,441. Back in the day, University of California tuition, I believe, was free for residents. That, unfortunately, is no longer the case. This is a situation where there are many people who could benefit from taking advantage of tax advantage plans who haven't done it. This is just a country where we aren't saving and we're not investing enough. I'll turn to the next slide. And so, of course, the hunt for income is critical. Capital appreciation and having as much exposure as possible to capital appreciation is important. If you want to just turn to the solutions to consider. So let me just stop here, actually, and see if there are any other questions. I may not have touched on what you're worried about today, so feel free to ask me about anything, even if I didn't cover it. Yes?
In terms of emerging markets, you saw that China and India seem to be outpacing the rest of the emerging markets. I imagine China is due to manufacturing, but what about India? What are the primary drivers of the economic growth in India?
Well, so there are a few different drivers in India. Over the last few years, India's prime minister has done a great job trying to reform India. You can almost think of India as in many ways the antithesis of China. There's a respect for and protections for intellectual property, but there's no infrastructure in India. And there's a fair amount of, and similar to China, there is a fair amount of corruption in India. It's a decentralized system. And so what they've tried to do over the last few years is make it more centralized, try to find ways to wipe out the need for bribes to do business, and build infrastructure. So some of the GDP growth is definitely due to an infrastructure spend. Some of it is due to greater reforms that have just made financial services easier to utilize, and so we're seeing more consumer spending as the economy has improved in India. So there are a few different drivers, but it's definitely been government spending, it's been consumer spending. Interestingly, I don't think infrastructure is where it is so that you will see it attracting a lot of factories that are in China today. Now, there are reasons to leave China beyond just this trade war, right? The costs of paying Chinese employees have gone up a lot. So I think the beneficiaries will be countries like Vietnam. But definitely India is in a place where in a few years, if it improves its infrastructure enough, then you could actually see more factories move there. But it's not uncommon to have blackouts on a regular basis. You just can't run factories like that. But they're definitely spending on infrastructure. It's been a big part of Modi's plan. So I could see that.
Do you see that growth continuing in India?
I do. They've experienced some hiccups, but I think they're in a good place, and I think investors have confidence in Modi. So we're certainly seeing some foreign investment going into India, and some are actually doing it just as a counterbalance to China, I think. Yes?
The seminar invitation said you were going to talk about foreign exchange rates and the strong dollar in terms of investing.
Sure. Actually, if you were to look at the earnings calls from the second quarter, the biggest concern was not trade. It was the U.S. dollar, and especially as it relates to more multinational U.S.-based companies. And so that continues to be an issue. What I will tell you is that my expectation is the U.S. dollar remains strong as long as expectations are that the Fed remains hawkish. Because the strongest are that the Fed remains hawkish. So if you look at the last couple of years, and if you were to try to look at what's moved the U.S. dollar, the factor that seems to have the closest correlation with it is expectations about the Fed funds rate. Not actual rate hikes, but expectations. And so once Powell came in, we saw expectations go up really quite significantly about rate hikes. And you may have seen there's an 80% expectation that, based on Fed funds futures, that we'll see a December rate hike. So that's likely to keep the dollar strong. There's also an assumption that the U.S. wins the trade wars. That will keep the dollar strong. But I think if we have any kind of economic weakness and there's a sense that the Fed is going to take its foot off the gas pedal for 2019, we're likely to see the dollar weaken. Or if we see signs that the trade wars are impacting the U.S. economy. So I actually expect the U.S. dollar to moderate, maybe not tomorrow, but relatively soon, because we're starting to hear companies talking about how input costs are higher. In fact, that's one of the reasons why I believe we're experiencing the sell-off today that we are, is because input costs are higher for companies. And hopefully that will enable the administration or encourage the administration to back off a bit with regard to the trade war, because we could be fighting it on multiple fronts. The situation with the European Union isn't going well either, and we could be applying tariffs to some of their items. So this is all just bad for economic growth and just makes economic growth more inefficient. And that would probably weaken the U.S. dollar, all else being equal.
So nobody's spoken about the election. So if the House goes to the Democrats, which might, then we'll have complete gridlock in this country. Not much gets done now, but that will be even worse. So what effect do you think that'll have?
Well, what I would say is I think we've gotten the best of the administration's agenda already, right? We've gotten business deregulation and we've got the tax reform package. And a lot of the recent components of the agenda run counter to growth, right? This focus on the trade wars. I don't think we're going to get much more in the way of tax cuts. So from my perspective, this is probably not a bad time to get gridlock because it will take some pressure off markets.
Did you say it's a good time to get rid of Trump?
No, it's a good time to have gridlock because we just don't have any the only pro-growth, really strong growth item on the agenda that we haven't visited yet is infrastructure. And so that could actually happen. That's more likely to happen with a Democratic House. So that could be a positive. I mean, I just don't think it's going to be an event. I just don't see the midterms being as important as everyone thinks they are.
You have a question?
Yes.
I have the mic too. Yeah, earlier I think it was mentioned something about growth 5.1% in earnings. I'm just wondering if you have any idea how much of that is due to the tax cut, corporate tax cut.
So the statistics I saw for the first quarter suggested that they got about a nice boost, 10 to 20% improvement in earnings as a result of the tax cuts. I haven't seen statistics since then. I would argue that the greater positive is just an improvement in sentiment. And so that's had a halo effect. Business deregulation has also impacted it in a way that's hard to quantify, but I would argue that it's encouraging business investment. So those are all great things that are difficult to quantify, but I feel strongly that they're there.
Sounds a little like smoke and mirrors, though.
Well,
How long can that continue?
Well, actually, interestingly, if you were to look at the Congressional Budget Office, they actually have done something, and they've looked at the next decade at the impact of the tax reform package. And interestingly, it is expected to have its greatest impact on GDP growth in 2021 and 2022. So the best is yet to come. And I think that will provide a nice support system so that if we see economic growth decline because of the trade policies, that it'll still have some support. We won't get into a recession because we'll have that tax reform supporting the economy and economic growth. But again, that's why I think it might not be a bad thing if we see some gridlock now, given that the administration is focused on trade and really in particular picking a fight with China. Yes?
Do you think that we'll see any of the support groups that have left the country mostly to China for electronics will start to come back to the United States because of these microchips, for example, that are being reported in many of the information systems? Do you think there'll be any resurgence of that in the United States?
It's probably unlikely. What I would expect is that if there are concerns, and it doesn't seem to be to jive with what corporate management teams have been saying about it, but if they are concerned, I would imagine they might move operations to a Vietnam, to someplace in Southeast Asia. It could be a situation where they move back to the U.S., but I think it's relatively unlikely. The other thing we have to worry about is that we might have higher energy costs. We now are not able to buy oil from Iran, so that places greater emphasis on being able to get our oil supplies elsewhere. It's more important now, and of course we have this growing issue with Saudi Arabia, and there are questions about how exactly the U.S. will ultimately deal with it. And what we found is that one of the key reasons why companies have onshored, why they've brought factories back to the U.S., is because labor got too expensive in China, and even more important, energy costs got lower. So if energy costs go up, and we've certainly seen a very nice energy renaissance in the United States, but if we were to not be able to source enough fossil fuels and it became more expensive to buy energy in the U.S., that would probably be a deterrent. Oh, sorry. I am running out of time, but let me just stop and say thank you so much for coming today. You are in incredibly good hands, and so I hope that this was informative, but didn't worry you today, because you're investing for the long term, and I think these will all be relatively minor hiccups in the shorter term. So thank you all so much for having me here today, and I'll turn it back. Thank you.
Thank you. Thank you so much. Thank you so much. You're a real beacon of light among all the craziness in the headlines, and it really is a great pleasure to hear you. Your clarity of thought, the breadth of material, the graphics which supported everything was really terrific. Thank you. Thank you to Invesco. We're proud to partner with people like Invesco in designing portfolios for our clients. The requirement of the law says we have to tell you that nothing here shall be deemed to be investment advice. That past performance is not indicative of likely future returns, that you should only invest after you've carefully reviewed and relied exclusively on prospectuses. Okay, having covered the legal and the gratitude, in the inverse order, gratitude always comes first, I want to just, first of all, thank all of you for coming as well. It's great. You make our lives, as Jonathan said, meaningful and productive. I want you all to know, those of you that are clients and those of you who aren't clients yet, and by the way, we divide the world into two. Those who are clients and those who aren't clients yet, should know that you have a whole team of tax and advisory people available to you as part of the services we provide. Between now and the end of the year, you should be meeting with us to discuss your if you're not doing it with your CPA, you should certainly do it with us, your 2018 tax planning, because as we say, surprises are for birthdays, not for tax time. And the last thing you want is a surprise. So tax planning is a critical part of what we bring to the table. It's the second leg, because everyone who is a wealth manager in our firm is also a CPA. So I want to just encourage you and invite you to use that facility to optimize your own situation. If you're doing it already with somebody else, great, although even there a second opinion would only be good for you. And then just a little perspective on RVW's approach. Thank you. We agree with everything that was said before, obviously. We're much less concerned, as Jonathan has said, about the noise, more concerned about the real situation. The economy is strong. Growth in a typical well-constructed portfolio is around the earnings yield. If you look through, using Buffett's word, if you look through to see what you were actually earning, assuming that you actually owned fractional pieces, which is how we view things, your return is close to 6%. If you add even some moderate growth factor onto that, you can pick the number 2, 3, 4, 5%, add that onto the 6. You can see you can easily approach double-digit returns over the next decade or so if growth is reasonable. It doesn't even have to be spectacular, as it has been over the last couple of years. So we're very optimistic about the market. A little perspective on that. First of all, the way we view the market is, imagine a person walking up the stairs with a yo-yo in his hand. Your job is to watch the feet and not the yo-yo. And the news every day is the yo-yo. So the feet is the earnings. We keep our eye on earnings, and corporate earnings are strong. And we seek always to design portfolios that, in a Darwinian model, are overweighted towards the best companies. That's why we sleep at night so peacefully. And finally, thank you. That's terrific. One more final point is my own story. I came to this country in 1977 from South Africa. The Dow Jones was just cresting 850. Today, even after what collapse we might expect, is probably around 25,000. And if you add the dividends over those 42 years, you probably come up at about 33, 34,000 from your 850. So the key is stay buckled in. The ride is bumpy. The road ahead is glorious. And nothing to worry about. Planes don't fall out of the sky. We are aloft. We're flying 40,000 feet, and we expect everything to be fine once we've got through this. We're much less concerned about the trade wars than most other people are. We take a very skeptical view of the news every day and believe that things have a way of working out. A lot of the trade wars are about dislocation, which will be resolved. So when China stops buying soy from the United States, they'll buy them from South American producers, and the people who are currently buying the South American produced soybeans will start buying from the United States. A lot of this is just a giant merry-go-round. If you take the skeptical view, you realize the economy and the forces are powerful, and they tend to equilibrate over time. And so don't be too nervous about what you see. The market's powerful. The entrepreneurial spirit is alive and well. And make sure that things are resolved over time. And the last point I will make to you is, over 200 years, the markets, the broad equity markets, have not done well all the time, but they have done well over time. And if you can cope with that distinction, welcome to RVW. Thank you. Have a great day.